Hi, this is Jordan Moorhead with the Austin Real Estate Investing Podcast. Today we have Trevor Thompson on. He's going to talk to us all about how he's investing in the Austin area and why he likes both passively and actively investing. Hey, Trevor, how are you?
Awesome. Thanks for having me here.
Yeah, thank you for coming on. So really quickly, could you tell our guest who you are and how you're involved with real estate investing in the Austin area?
Yeah, so my name is Trevor, originally from Canada. Been in Austin now for a little over 12 years and started passively investing 5 years ago and super active in the Austin real estate market, run a couple of meetups and go to a lot of meetups and connect with people and very active in the Austin community for sure.
Awesome. And why do you like investing in the Austin area, Trevor?
Yeah, so I love it because it's just such a high growth market, right? There's just so much potential. Even right now, things are a little bit dicey. I still believe big in Austin. There's so many people coming here. There's so much money coming here. There's such a shortage of housing. And I think it's going to be, 10 years or more before Austin ever catches up, if it ever does, to the housing that it needs for the population growth. And, I always sort of say this funny thing. When I first moved here, I drove by a field with cows, and now I drive by about 30,000 apartments and a light rail station coming home. I mean, it's just the development has been staggering.
Yeah, no, it's surely amazing. Trevor, what first attracted you to real estate investing? So obviously you're doing a lot now, but how'd you get started?
Yeah, so 20 something years ago, somebody gave me a copy of Rich Dad, Poor Dad. I read that book and went, man, this is something I really need to do. And then to be honest, like most people, I put it on my shelf and I, gave my soul to the man and worked for a company and, I loved it. And, I kept growing and growing and doing great things in the company. And then finally we did get bought out by a private equity company. So that gave me a little bit of a payday. So I said, okay, now I have no excuse not to switch over and start at least passively investing in real estate. And I started and, I went at it full tilt. So I've been 4 years and I've invested in 18 different syndications.
Wow, that's awesome. So that's a big number, 4 years. What is that? How many a year is that?
Yeah, it's too many.
Almost 5 a year.
A lot. Yeah.
Yeah, 4.5 a year or so.
And it was never intended to do that many, but the market was just so competitive. So I would cash in some stocks or some SAY or whatever it was to go after a deal. And then, it's a hot competitive market and it just overheated and I couldn't keep up with what prices to pay. And so then a passive deal would come along. So my last apartment complex, for example, I passed on making an offering on it. And then a year later, I participated as a passive investor. Big mistake. I could have really done well if I had been a little more aggressive. It's just scary.
No, I completely understand that. So you've done a lot of passive investing, and you said, I want to hit on what you just said really quickly. That hey, because I've had this same experience. Hey, this deal came up and it was right in my face. And then I see somebody else do that same deal a year or so later. And maybe a couple of years later, they cash out and they crush it on that deal. So can you give our listeners some advice on how you've gotten comfortable with pulling the trigger? And maybe I think I might know some of the answers to this, but I just want to hear your perspective on how you've gotten comfortable with saying, hey, I know I can do this deal. Yeah, maybe it looks like the numbers are a little tight, but here's how I'm getting comfortable with doing deals right now.
Yeah, so the deal that I mentioned before, it had some pretty significant deferred maintenance and it was a little over my skill set. And unfortunately, call for offers was in a couple of days. And if I'd have known what I know now, I could have pushed it. I know way more people. I could have got some people in to estimate the work. And I looked at it and said, this is either $1 million problem or a $3 million problem. Well, they took it off the property, fixed it. It was $1.5 million problem, but they sold the property for $3 million more than I was looking at it for. So again, within less than a year, They did fix the problem, spent $1.5 million, but the value of the property went up another $1.5 million. And then someone else bought it, and I passively invested in it going, wow, if I'd have been that guy that had bought it back then, and I could have been here or better, because I actually still think it's got a lot of value add. The nice thing about the Austin market is regentrification is happening quickly, and this one was at the edge of where it's happening. And, even in the short year, it's everybody's buying these, cleaning them up, and I'm going to say fixing and saving the neighborhood. So it's something that happens in a city that experiences so much growth like Austin does.
Love it. Yeah. So you saw that you missed a lot of opportunity there.
Yeah.
So what's something you tell a newer investor that's starting to get into investing and they're a little nervous to do deals like this?
Yeah, so I think the advantage I have now is I've aligned myself with the broader base of skill set. Real estate is a team sport. And at the beginning, I didn't have what I'm going to call a strong team. And so now I've got a much stronger team. So I've got a good connection with a property manager. I got a good connection with a rehab company. I got a good connection with somebody that does underwriting better than me. I've got some connections with people that aren't afraid to put hard money down and move towards a deal. So I've assembled what I'm going to call a little stronger team, where before I was, trying to say, okay, I'm going to go get this deal and go find them. And that was very scary. So finding them in advance, realigning yourself, makes it not near as intimidating when, you've got to close in 60 plus days. That's a lot of pieces to put together, and hope everybody likes the deal you got and joins in.
Yeah, absolutely. I could see how that would be nerve-wracking.
Yeah.
So I want to talk a little bit about your passive investments, because we don't have too many people that come on this show and talk about passive investing. So I think when I first got into real estate investing, I heard that, well, this is passive investing, this is passive income. Can you explain the difference? And I'll give my perspective here later, but passive investor versus an active investor and what the difference is?
Yeah, so it's very interesting. So I think that the best analogy is we're all getting on an airplane, and the active investor is the pilot, and he has a co-pilot, he has some stewards and stewardesses, he has a mechanical team that's making sure the plane's ready to go. And then the passive people are the passengers. So we paid money to get onto a plane, and we're hoping to get to a destination, and our destination is, creating more wealth and getting, having our passive income, pay us dividends, pay us, different things. So it's very interesting way to look at it. And so we're paying for the ride, but all we got to do is drink the Coke and eat the peanuts. I guess they don't serve peanuts anymore, but
yeah.
We don't have any responsibilities. Where the active person, they have to have a plan, right? So they need a flight plan. Where are we going? What are we going to do? What do we need to accomplish our mission? And do we have enough fuel to get there? And all, do we got to change the tires? Do we got to do this? So that's what I think is the best analogy for looking at it in a very simplistic point of view.
Yeah. So basically, you're the active investor, you're doing all the work.
Yeah.
And the passive investor, you're just investing, you're putting your capital to work.
That's correct.
And it's essentially doing the work for you. So you're getting paid out. And I like that, to look at what's your time worth too when you're looking at deals like this. With an active investor, it is a lot of work. So it is, you are doing a job here as an active investor. As a passive investor, you're purely putting your money to work. All of the work per se is done in the beginning.
Yes.
So you're doing the due diligence, making sure you're in the right spot.
Yeah.
But why I think passive investing is so powerful is, people see the returns, they say, oh, well, 7 or 8% cash on cash, whatever, 15% IRR, that's not that good. But you don't have to do any work for it. And that's the magic in passive investing that I see, is you do zero work and you can get much better returns than you're going to get in the stock market, typically with less risk. and with tax benefits too,
That's
so
correct. Yeah. So the combination of, you don't do anything, the combination of the tax benefits, all the different things, the fact that it comes to you at a better tax rate, better than your, and then you get your passive losses from like depreciation and accelerated depreciation. So in theory, you could pay no tax on your passive income. Where if
Mhm,
you make money in the stock market, you're going to pay tax on it if
mhm,
you sell your share, do your things. So it's a big, big, big advantage that a lot of people don't. Plus, the market, yes, there's what crashed many years ago. It happened, right? We may have a little adjustment right now. But look at the roller coaster ride of the stock market. Like, I remember after COVID and the world shut down, I woke up and I was worth 30% less, and I had 80% of my money in the stock market. That's a
wow,
significant hit.
yeah,
Crawled out of it. And so, that roller coaster ride, it's different. Everybody needs a house.
mhm.
Everybody does.
No, I agree. And then back to the active versus passive is, on the active side, you're doing a lot of work. I mean,
Yeah,
it can be quite a bit of work, and it is another job. So people saying, "Hey, I want passive income." You're going to get a return on the money you invest when you're active too, but you have to do the work to produce that return.
that's
So,
correct. And on the active side, there's risks. Unfortunately, I had a deal. We had a pretty big property in San Antonio under contract, worked it for 6 months, and we couldn't close.
mm,
And as a group, we lost $350,000, which is substantial. I
well,
lost 75 personally, and all of the passive investors got their money back 100%. They lost a little bit of opportunity while we held their money waiting to close the deal, but they all got their money back,
yeah,
and they didn't take the risk. So there is the risk reward thing. So as an active, you definitely get rewards, but you also take the risks and you take the responsibility, right? I think the biggest part is the responsibility, right? I've taken a portion of your life savings and I'm responsible for it. That's a big responsibility that every active investor should take seriously.
yeah, no, I like that. Um, so before we started on the show here, we did talk a little bit about passive versus active. So you've
Yeah.
done, you said 18 deals as a passive investor, and you're working on some as an active investor too. Could you talk
Yeah.
about those real quick?
Yeah, and I'll tell you why it happened, right? So I had a very good paying job and I was quite happy to passively invest and build my wealth. And I even invested different, right? I didn't invest for cash flow. I invested for wealth generation. For me, it was really important to build my wealth up. I wanted to, take my money and double it in 5 years was more important. I didn't need the cash flow. The cash flow was almost annoying because I had to take tax, figure out and when I say it's annoying sounds really entitled, but you know what I mean? It was just, I just wanted to create wealth. And then with COVID, I ended up losing my job. And I decided that instead of going out and getting another W-2, I would take what I'd learned and I would switch to active. So we had the deal that I just talked about that I was on for 6 months and we ended up losing. I got on a small deal right after that, which is close. So in Charleston, South Carolina, which is one of my few investments outside of the state of Texas. And then since then, I've joined a couple of other deals, one other deal, and then I got another property in San Antonio under contract. And each time I'm a bigger piece of the active. So the very beginning piece, I just raised a little bit of money and I have a couple of responsibilities. The second one, I'm with the boots on the ground part of asset management. And then the third one, I'm the full asset manager. And that means that, I'm responsible, right? I need to make sure the property manager's doing what they're supposed to do. I got to verify all the construction that hasn't been done, make sure that the draws get paid to the contractors. So it's a much bigger responsibility. It's not only creating the plan, but responsible for its full execution. But there are rewards on that side. There's your acquisition fees, your asset management fees, and then you own a percentage of the deal with only your efforts in it. I still passively invest in every deal, by the way, I'm active, and listeners should never invest in a deal that the sponsor hasn't invested in themselves.
Yeah, no, I agree too. The deals that I've invested in, everybody's all the passive investors, or all sorry, all the actives. So the GP have been passive investors in
Yeah.
the deal too. So awesome. So you're moving from passive to active here. You've done some passive investing here for a few years. And I think that's what people should do if they're trying to get into the active investing in commercial space. But Trevor, what's next for you? What are your long-term goals and what's your vision for real estate here in the future?
Yeah, so I definitely want to close 2 more deals this year, and balance it out. I've got a couple of passive deals that are coming due, and my goal is to balance it out. So, I hope within the end of about another 2.5 years, I'm about 10 active and 10 passive. I want to balance it out. And on my passive side, I also invest in different things just to learn. So I call it earn and learn. So I'm in a retail strip center, medical center, a new build storage unit. And those ones I don't know enough that I could take the responsibility on of doing them, but I want to spread out and be in a couple of asset classes just to balance out my portfolio a little bit and not be only multifamily focused. But on the active side, I'm staying multifamily because it's a space that I know and understand. And then I want to follow the model that a lot of people do, right? When you're first starting out, you're buying the scrappy deep value adds. Then you get to go to the B class with the moderate value add. And then next thing you know, you're on the A class with the, consistent but smaller cash flow. And then my ultimate goal is to own dirt. So I want to be CVS's, Starbucks, Walgreens landlord. And it's in theory the lowest return, but the safest return, right? And that's truly like, even if they shut down the CVS, they still got to send you a check because they're a big company and they got to do it till someone else leases the space. And that is my ultimate, what I plan to pass on for my generational wealth. They don't have to understand real estate to collect the rent check from Walgreens.
Yeah. So yeah, that's an awesome. You explain that so clearly, but I think everybody says, "Oh, I want a high return or I want a high cap rate," and like you said, the high return stuff is hairier and more risky to put together. So the deep value add, let's say C class property, like you're talking about, is going to have a higher cap rate or a higher return. But then you get further down the line, past A class apartments and triple net in a great location with a corporate tenant like CVS or Walgreens or Starbucks, and the cap rate's really low. Maybe it's a 2 to 3 cap, but Starbucks pays their bills no matter what. If the economy goes in the tank,
they do.
Starbucks is still paying.
Yeah, and there's a lot of spaces now created, especially during the pandemic, like the need for industrial spaces and stuff. It's staggering.
Awesome. Trevor, you mentioned Rich Dad, Poor Dad. I know that's a favorite of everybody. What is your favorite business or mindset book that you like to recommend to other people?
So purely on mindset, I'm a Grant Cardone 10X. Got to listen to it on Audible. And then you got to follow it by Be Obsessed or Be Average, also on Audible, because it's the application of 10X being, and I'm an obsessive person. And so I just soaked it up and done it and love it. And then on the real estate side, Passive Investing by James Kamasami. It's a great book that explains what does it really mean to be a passive investor, and even an active investor should understand it. And then I love Joe Fairless' Best Ever Syndication book. It is what I consider the simplest overview of how to syndicate a deal, kind of in step by step, almost boring, but exciting if you love it.
Awesome. Yeah, no, I love that book too. Trevor, what's the best way for people to get a hold of you?
Yeah, so I'm super active on Facebook and LinkedIn. So you can find me, K. Trevor Thompson, or you can reach out to me. My website is Niagara-Investments, and the email is ktt@Niagara-Investments. And the reason for the Niagara, I'm originally from Niagara Falls, Canada.
Oh, cool. That's awesome.
Ties in.
Yeah. So Niagara-Investments.com and then K. Trevor Thompson on LinkedIn and Facebook most commonly. All right, Trevor. Most important question we ask here on this podcast: what is your favorite restaurant in Austin?
Yeah, so in the Domain, there's a place called North. It's an Italian, sort of northern Italian restaurant. Don't go in the summer and sit in the patio. It's a little brutal. But in the spring and fall, it just feels like you're in a whole different world, right? You sit on the patio, the food is amazing, the service is great, and the prices are reasonable. So those three things, it's sort of my go-to if I have a visitor into town, especially spring and fall, where people are still coming from cold, rainy weather. In Austin, it's just beautiful. So that's my favorite.
Yeah, I love that place too. Is it North in the
Yeah,
Domain, and
yeah,
it's Italia too.
yeah, and it's really good, and it's just nice, consistent, northern type Italian cuisine.
Awesome. Well, Trevor, thank you so much for coming on here today. Again, if anybody wants to reach out to Trevor on Facebook and LinkedIn, look up Trevor Thompson, and we'll have all this in the show notes. And then NiagaraInvestments.com, correct?
That's correct. Niagara Dash.
Niagara.
There's a dash in there. I had to add the dash. Somebody else had that all one word.
Oh, all right. So remember, guys, we will have that in the show notes so everybody can reach out to Trevor and learn more about what he's doing here in the Austin area.
Thanks so much for having me.
Yeah, thank you for coming on here, Trevor, and we will talk to you here soon.
Take care.